Hi, Norman Hallett here with your next 4-minute drill for traders. I want to talk a little bit about options today, and this short discussion might interest you even if you don't trade options, so stick with me. Now, as many of you may know, I ran the home office for one of the largest option brokers in the country in the 1980s, so I do have some experience in this area. I want to address the best time for small accounts to buy puts or calls. And I'm addressing the simple buying of calls and buying of puts because many traders with small accounts or just starting out with options simply buy puts and calls. Now, in the long term, simply buying premium, that's the price you pay for a put or a call, is not the ideal use of options as speculation, but it's still the most common use of options, the straight buy, the straight buying of premium. Okay, let me give you a technique that I've seen work to make some nice profit. What you pay for an option, the premium price, is very highly influenced by volatility. In the case of call options, a single day dramatic move up can increase the option premium substantially, while a dramatic move down can decrease the premium dramatically. A good basic rule is to watch for markets that have been moving sideways for a while, where the volatility is low and therefore the premium is going to be low. When the underlying stock or commodity bolts higher, the option premium on that stock or commodity will also bolt higher. I like to buy the call option on that first bolt up. And that's very hard for many traders to do because the premium price before the bolt up was much lower, and it's easy to feel that you're overpaying. The next day, if the market continues higher, even just a small amount, it's going to make this breakout more believable, and all the option players come running in and buying. It's this spike up that can be the big one, creating an even bigger jump in the premium than the first day. That's where you'll consider selling part of your option position. The more a move is obvious, the more you'll pay more for it in an option. And the first bolt up, although jolting, is still not believable to most traders, and therefore still winds up being offered at a very fair price, even though it may look too high to the new trader. The hesitant buyer tends to protect his or her ego by staying out of the market, wanting it to return to the price before the breakout, and then making him or her a hero for not getting sucked into the false breakout. Well, when the second move happens, or that first breakout even holds the next day, the initial move is more believable and everyone jumps in and the demand pumps up the option price. Now you've got a better case for the premium being overpriced, so you take the premium by selling your option back to the market. Now on the other side, if on the second day the market backs off, it will still hold a lot of that demand premium from the first day's pop, and you'll be able to exit without much damage if that's your plan. My experience is that the second day jump in premium is so big it'll cover 3 or 4 false breakouts. So it's a simple trading plan that can work for you and work for you as a new trader, but you have to be patient, and when the breakout comes, you can't be afraid to pay up on the first day. And then most importantly, you can't be greedy and not take the at least partial profits when everybody piles into the market on the second day of the breakout. Okay, how about you? Do you have a simple options plan that you believe can work over time? The operative word being simple. Let's hear what you have to say about my simple options play, and I want to hear about yours, so don't be shy. Leave a comment. Okay, that's it for this edition of 4-Minute Drill for Traders, so until next week, stay disciplined.